It feels incredibly safe to keep your life savings sitting in a bank account, but that cash is actually falling behind. According to the Federal Reserve, the US dollar has lost half of its purchasing power just in the last few decades. This chart illustrates exactly how that drain works. It acts like a down escalator, tracking your uninvested cash as it loses roughly 2% of its purchasing power every single year. Over a 30-year timeline, your savings literally lose half their value to inflation. To overcome that inflation, you have to put your money into the stock market. But if you've never invested before, watching the market plummet into a sea of red is terrifying. To get past that fear, you need a system. We're going to walk through a 5-step, beginner-friendly roadmap to calculate exactly what you need for retirement, protect your assets from market crashes, and make your first hands-free investment. Because putting up with the short-term ups and downs of the stock market is the only mathematical way to beat the guaranteed drain of inflation. Step 1 is building your cash shield. Before you buy a single stock, you need a starter emergency fund of at least $1,000, with the ultimate goal of saving 3 to 6 months of living expenses. This cash buffer enforces the most vital rule of investing: never put money into the market that you might need to survive over the next 10 years. When the economy took a massive hit after September 11th, a lot of people suddenly lost their jobs, including my dad. Our family went months without any income. Because my parents didn't have an emergency fund, they were forced to sell off investments just to pay for basic living expenses, right when the market was at its absolute lowest point. That early withdrawal locked in those massive losses and permanently wiped out my sister's and my college investment fund. Your emergency fund is your armor. It ensures you never have to panic sell your investments to cover a broken down car or a medical bill. Now that you have a shield, step 2 is calculating your target. You need to know the exact dollar amount required to successfully retire. To find that number, we use a simple calculation known as the Rule of 25, or the 4% rule. First, pick the annual income you want to live on in retirement, using today's dollars. Let's say you want a $50,000 lifestyle. If you plan to retire in 15 years, inflation means that $50,000 lifestyle will actually cost about $67,000 a year. Take that future requirement of $67,000 and multiply that by 25. That gives you your exact target, a $1.7 million nest egg. Having a concrete target takes the vague, emotional guesswork out of the process. You are now just solving a simple mathematical equation. Step 3 is picking the right vehicle to hit that target. That means opening a tax-advantaged account, like a Roth IRA, at an established brokerage firm. A lot of beginners download an app like Robinhood and start trading in a standard taxable account. This chart shows why that hurts you. Whenever you make a profit in a standard account, capital gains taxes will shrink your money by 20 to 40%. Meanwhile, the Roth IRA side stays completely intact. Because a Roth IRA grows legally tax-free, your money compounds year after year without the IRS taking a massive bite out of your profits. Once your Roth IRA is open, step 4 is choosing a set-it-and-forget-it investment. The easiest way to do this is by searching for and buying a broad, low-cost index fund. Reading through annual reports and trying to pick winning individual company stocks takes a massive amount of time, effort, and risk. 90% of people simply do not have the time to do it. With an index fund, you own a piece of the entire market. Historically, this approach yields a 7 to 10% average annual return on complete autopilot. Combining a tax-free wrapper with a broad index fund gives you a powerful vehicle. It automates your wealth generation while shielding every dollar of profit from taxes. Step 5 is getting into the market today. Start with a small, manageable amount, like $100. Watching a $100 go up and down trains your nervous system to handle market volatility. You need to get comfortable with those fluctuations before you start putting your life savings on the line. Many beginners sit on the sidelines, trying to time the absolute perfect bottom of a crash to buy in. But nobody knows when the market has bottomed out until after we've passed it. If you look closely at this stock chart, you'll see sharp, erratic drops. The market yo-yos constantly from month to month. But this chart shows what happens when you zoom out to a 5-year timeline. That short-term choppiness fades away into a massive upward trajectory. Spending time in the market with small, consistent investments will always be trying to time the market with large sums. You now have a complete bulletproof framework. Build your cash shield, calculate your numeric target, open a tax-free vehicle, and buy a low-cost index fund. Your immediate homework is to break the seal of hesitation. Log off, open your Roth IRA today, and make that first $100 investment. Once you build up your emotional tolerance, you can set up automatic monthly deposits. Scale up to $500 or more a month, and let it march toward your calculated nest egg. Taking deliberate action today puts you in the driver's seat. It is the only reliable way to seize control of your financial destiny and permanently outpace inflation.